Okay, let's unpack this. Imagine you just bought the latest, fastest graphics card for your gaming PC, manufactured, say, in Taiwan.
Mm-hmm.
Or perhaps you just paid a pretty hefty subscription fee for that super popular streaming service designed entirely in the United States.
Right, happens all the time.
Did you realize that in that instant, you didn't just spend money, you actually caused a tiny, immediate, well, like a shockwave in India's national economy?
Yeah.
And someone, somewhere, actually had to write that down.
That wave, that movement, it's the absolute signature of our interconnected world. Welcome, everyone, to the Deep Dive. I'm Grace.
And I'm Adam. We're educators here at School on X, and yeah, we genuinely live and breathe this stuff, especially the tricky bits of econ, too.
We really do. And our mission today is pretty crucial for anyone moving past the basic textbook models. We're leaving the kind of simplified world of the closed economy.
Yeah, where we pretend all the money just stays within our borders.
Exactly. And we're diving headfirst into the messy but honestly exhilarating reality of the open economy.
We've got some great source material here. It really breaks down how international accounting works, how currency markets function.
Fantastic stuff. And our job really is to take all these complex links and turn them into those aha moments for you. We want to show you how India, how your country, keeps track of every single rupee flowing in and out.
And maybe even more importantly, how all those flows actually ripple through and affect our national income, government policy, the whole works.
Get ready for some insights. It's going to connect a lot of dots. So fundamentally, what is an open economy? Well, it's basically an economy that interacts with other countries. Lots of different ways, lots of channels. We just can't analyze our national economy in a bubble anymore.
No, absolutely not. We're constantly exchanging things, output, financial assets, even to some extent labor.
And these interactions, they aren't just small side notes. They are right at the heart of modern macroeconomics. Our sources lay out three main ways countries link up globally.
Let's break those down.
Okay, the first one, and historically, the most obvious one, is the output market. This is just trading goods and services, everything you can see, everything you can't.
Like cars and clothes, but also software development or tourism.
Precisely. And because of this link, both consumers and producers get way more choice. We here in India can get electronics from South Korea, maybe wine from Chile.
And at the same time, Indian textiles or software services, they're being bought all over the world. Exports.
That's the output market. Then number two, equally powerful these days, is the financial market linkage.
Ah, the money flows.
Exactly. This is where investors, big banks, small individuals, everyone get to choose. Do I buy Indian stocks or bonds, or do I look overseas?
So if a Japanese bank buys Indian government bonds, that's this linkage.
Yep. Or if you decide to buy some shares in an Australian mining company. That's the financial market linkage working. It's all about capital moving around the globe, chasing the best return. It's huge.
Okay, output and financial markets. What's the third?
The third is the labor market. So think about workers moving across borders or multinational companies deciding where to set up their factories.
Right, although that one often has more restrictions, like immigration laws.
It does, yeah. There are often high walls there. Sometimes economists see the movement of goods as like a substitute for moving labor itself. But honestly, for our deep dive into Econ 2, we really need to nail down the first two, the goods and services trade and those financial asset flows.
Okay, let's focus there. Let's go back to that Taiwanese graphics card you mentioned. Buying that creates a foreign trade shockwave on our aggregate demand, or AD. And this is where that idea of leakage really matters.
Yes, leakage. When residents here, individuals, companies never buy foreign goods or services, we call that payment an import. And imports act as a leakage.
Why leakage?
Because that spending literally escapes our own circular flow of income. The money goes to the foreign maker, right? It becomes their income, not income for someone here in India.
Ah, I see. So that leakage decreases the total demand for goods produced right here, domestically.
Exactly. But then there's the flip side, the economic superhero, as you called it, exports.
Right. When foreigners buy Indian goods or services, the money flows into our economy. That acts as an injection.
A vital injection into our circular flow. This directly increases the aggregate demand for stuff made in India.
So it's this constant push and pull, this global tug of war between imports leaking out and exports injecting in that really shapes AD in an open economy.
It's happening constantly, instantly. And this whole movement of goods immediately raises a practical problem, doesn't it?
How do you actually pay for it all?
Precisely. When that graphics card maker in Taiwan sends you the bill in, say new Taiwan dollars, you can't just send them rupees.
No, they wouldn't know what to do with them, probably. There's no single world currency. And unlike inside India, where the RBI says this is the rupee, you use it internationally, well, it's all about trust.
Totally. Why would someone in Taiwan accept rupees unless they were absolutely confident that those rupees will hold their value, their purchasing power, tomorrow, next week, next year?
They probably wouldn't, or they'd charge a massive premium to cover the risk.
So because there's no universal currency, every single international transaction needs a conversion. We have to know the price of one currency in terms of another.
And that price is the foreign exchange rate.
That's it. It's the number that connects our domestic prices to international prices. It tells you exactly how many rupees that, say, $10 component from Taiwan is going to cost you right now.
Okay, so we have these massive continuous flows of money crossing borders for goods, services, investments. How does a country even begin to keep track of it all?
Yeah, it sounds incredibly complex. You need some kind of system.
You do. And that system, that official scorekeeping mechanism, is called the balance of payments, usually shortened to BOP.
The BOP. Okay, so think of it like a country's financial diary, meticulously recording everything.
That's a great analogy. It's a systematic record, usually using a double entry accounting, of all economic transactions. We're talking goods, services, and assets between the residents of a country like India and the rest of the world over a specific period, right? Like a year.
Typically, yes, usually a year. And because it uses that double entry system where every transaction has two sides, a debit and a credit, well, mathematically the whole thing must always balance out to zero in the end.
Always balances. Okay. Now, our sources mentioned two main accounts within the BP that the RBI, the Reserve Bank of India, focuses on.
That's right. The current account and the capital account. Now, just a quick technical point here for clarity. The IMF, the International Monetary Fund, they've actually moved to a 3-account standard more recently. They split off financial asset transfers into a separate financial account.
Okay, so IMF uses 3. But our curriculum, Econ 2, and the RBI practice often stick to the traditional 2.
Correct. The RBI largely sticks with the 2-account system, mostly for practical reasons and continuity. They basically group those financial asset transfers, especially the long-term ones like debt and equity investments, under the capital account umbrella. So for this deep dive, we'll stick to that 2-account structure, current and capital.
Perfect. Let's dive into the first one then, the current account.
Okay, the current account. Think current flows things related to the day-to-day. It records trade in goods, trade in services, and also something called transfer payments. If something is essentially consumed or used up within the reporting year, it generally belongs here.
Makes sense. So starting with the most obvious bit, trade in goods, physical stuff.
Exactly. Also called invisible trade because you can, see it and touch it. Exports selling Indian goods abroad are recorded as a credit. Money flows in.
And imports buying foreign goods are a debit. Money flows out.
Right, and the difference between the value of all goods exported and all goods imported is called the balance of trade, or BOT.
So if India exports, say, 100 crore rupees worth of textiles, but imports 150 crore rupees worth of oil and machinery,
then we have a trade deficit of 50 crore rupees on the goods account. And historically, yeah, India often runs a trade deficit, largely because we import a lot of essential things like oil and capital equipment.
Okay, that's goods. What else is in the current account? You mentioned services and transfers.
Yes, the invisibles. These are flows you can't physically see, but they're incredibly important. This bucket includes services, income flows, and transfers. We need to break this down carefully.
Let's do it.
First up within invisibles is net factor income. This is about the earnings on the factors of production, primarily capital and land, that are owned internationally.
So like interest earned by an Indian investor on bonds they own in the U.S.
Exactly. Or dividends received from shares someone here owns in a foreign company. Or profits sent back home by an Indian company operating abroad. It's the return earned on assets owned across borders.
Okay, this is a really crucial distinction. I've seen students sometimes mix this up with remittances, like money sent home by workers abroad.
Ah, yes, that's a common point of confusion. But under the strict BOP definition, remittances are not factor income. If an Indian engineer working in Dubai sends money home to their family,
That's something else.
that's a transfer payment, which we'll get to. Factor income is purely the earnings from assets. The second part of invisibles is non-factor income.
Okay, what's that?
This is basically the net sale of services. Think shipping services, banking services, tourism, and of course a huge one for India, IT and software services. Selling those services abroad generates massive foreign exchange inflows.
Right, the service sector exports.
Mm-hmm.
Got it. Factor income, non-factor income.
Hmm.
What's the last piece of the current account?
The last piece is transfer payments. These are receipts or payments where nothing is given in return. They're for free, essentially.
Like gifts or foreign aid.
Exactly. Gifts, remittances. This is where the money sent home by non-resident Indians working abroad fits in, and also official grants received from foreign governments or international organizations. These can be really significant inflows for many developing countries.
Okay, so goods, factor income, non-factor income, and transfers. All that together gives you the current account balance.
Precisely. You add up all the credits, inflows, and subtract all the debits, outflows, across these categories. If the result is positive, you have a current account surplus. If it's negative, it's a current account deficit.
And what does that deficit tell us if our payments are greater than receipts?
A current account deficit basically means the nation as a whole is spending more than it's earning from the rest of the world in that period. It implies we're a net borrower from the world, financing our extra consumption or investment by using foreign resources.
Okay, borrowing from abroad, essentially. Now, what about the second main account?
Yeah.
The capital account.
Right, the capital account. This one is fundamentally different. It doesn't track current flows. It records all international transactions that involve a change in assets or liabilities. If a transaction affects future claims, it belongs here.
Assets meaning money, stocks, bonds, property.
Exactly. Things that represent a claim to future income or value. Let's use a couple of examples to make it clear. Suppose a major Indian company, like Tata, buys a controlling stake in a car company in the UK, like Jaguar Land Rover. Indian capital is flowing out to acquire a foreign asset.
So that's a debit, an outflow on India's capital account.
Perfect. Now, the reverse. Imagine a big American tech company decides to invest heavily in building a new research center here in Bangalore. Foreign exchange flows in to acquire a domestic asset, the research center.
That's a credit, an inflow on the capital account.
You got it. And the main components we look at here are really important for understanding the stability of these flows. First, there's foreign direct investments, or FDI.
FDI, that's like building a new factory, right? Long-term stuff.
Generally, yes. It implies a long-term interest where the foreign investor gains significant influence or control, building factories, acquiring a large chunk of an existing company. This is usually seen as stable, committed capital.
Okay, stable is good. What else?
Then there's foreign institutional investments, FIIs, often called portfolio investment. This is more about buying stocks or bonds on the open market. It's usually more short-term, more liquid.
Meaning it can flow out just as quickly as it flowed in? Hot money?
It can be, yes. That's why policymakers watch FII flows very closely. The capital account also includes things like external commercial borrowings, basically, loans taken by Indian firms from abroad, and also government-to-government assistance or loans.
So just like the current account, you can have a capital account surplus if inflows are greater than outflows.
Exactly. A surplus means more foreign capital is coming into the country to buy assets than domestic capital is leaving to buy foreign assets.
Okay, so we have these two main accounts. Current, tracking goods, services, income transfers, and capital tracking asset transactions. Now, you mentioned earlier that the whole BBOP system must always balance.
Yes, this is the absolute linchpin of the whole framework. It often trips students up, but it's an accounting identity. It has to balance. The sum of the current account balance and the capital account balance must identically equal zero.
Current account plus capital account, zero. Always.
Always. Let's use that individual analogy again. If you personally spend way more on groceries, movies, clothes, your current spending than you earn in salary, you have a current account deficit.
Right. I've overspent.
How do you cover that gap? You must finance it somehow. Maybe you dip into your savings account, maybe you borrow on your credit card, maybe you sell some shares you owned.
Okay, I draw down savings, borrow, or sell assets.
Exactly. At the national level, borrowing from foreigners or foreigners buying our assets is recorded as a capital account surplus. That surplus perfectly offsets the current account deficit. The money had to come from somewhere.
Ah, so the financing side, capital account, mirrors the spending side, current account.
Precisely. Remember the double entry bookkeeping. Every single international transaction has two sides. When you buy that Taiwanese graphics card, a current account debit for imports. The payment itself involves a foreign exchange transaction. That might show up as, say, an increase in foreign holdings of rupees in an Indian bank, or maybe a decrease in your own personal foreign currency account. When you trace the whole transaction through, it balances.
Okay, the identity makes sense. Now, this leads to distinguishing between different types of transactions based on why they happen, right? Autonomous versus accommodating.
Yes, this is key to understanding how the balance is actually achieved in practice. Autonomous transactions are often called above-the-line items,
Above the line, meaning
meaning they happen for their own economic reasons, totally independent of the BAPI's overall status. People trade goods to make profits or get things they want. Investors move capital to seek higher returns. These are driven by normal economic motives.
so most of the stuff in the current and capital accounts we just discussed, trade, FDI, FII, are usually autonomous.
Generally, yes. And if you add up all the autonomous credits and all the autonomous debits, and the credits are greater than the debits, we sometimes say the BOPI is in surplus at this stage. But it hasn't fully balanced yet.
Okay, so what balances it?
That's where accommodating transactions come in. These are below the line. Their only purpose is to bridge the gap left by the autonomous transactions. They don't have an independent profit motive. They exist purely to make the final BOPI accounts sum to zero.
And who performs these accommodating transactions?
This is the crucial role of the central bank, the monetary authority. In India's case, the RBI. Official reserve transactions are the main accommodating item.
Official reserves. You mean the country's holdings of foreign currency, like dollars, euros, yen, and also gold.
Exactly. Those reserves act as the ultimate buffer. Let's take a typical scenario for a developing economy, an autonomous deficit. Suppose after all the regular trade and investment flows are tallied, India finds itself needing, say, $5 billion more in foreign currency than it received.
Okay, an autonomous deficit of $5 billion.
To cover this gap, to ensure everyone who needs foreign currency can get it, the RBI must step in. It will sell $5 billion worth of foreign exchange from its official reserves into the market. This is an official reserve sale.
Ah, so selling reserves provides the needed foreign currency. And how does that balance the BOPI?
That sale, that decrease in the RBI's holdings of foreign assets, the reserves, is recorded as an accommodating credit entry in the BOPI accounts. It perfectly offsets the $5 billion autonomous deficit.
So the deficit is financed by running down reserves. And that decrease is the deficit.
Precisely. That decrease in official reserves is what we formally call the overall balance of payments deficit. It represents the amount the central bank had to intervene to make ends meet.
And what if there's an autonomous surplus? Say, massive software exports lead to way more dollars coming in than needed.
Good question. In that case, to prevent the rupee from appreciating too much or too quickly, which would hurt future exporters, the RBI would likely step in and buy the excess foreign currency from the market.
Adding it to the reserves.
Exactly. That increase in reserves would be recorded as an accommodating debit entry, balancing out the autonomous surplus. The central bank essentially acts as the ultimate buyer or seller of last resort for foreign exchange, absorbing the net outcome of all autonomous transactions.
Okay, this makes the whole balancing act much clearer. Can we see this in the data example you mentioned? Table 6.1.
Yes, that hypothetical table was really useful. It showed India with, let's say, a significant trade deficit, maybe nested 90 million USD. That contributes to a larger current account deficit, say, nested 38 million USD overall. That's the problem generated by autonomous trade and service flows.
Right, a gap of 38 million. How was it filled?
Well, in that specific example, the capital account showed a healthy surplus of 41.15 million USD. This was driven by autonomous inflows like FDI and perhaps some FII buying Indian stocks.
Ah, so the capital inflows, 41.15 million, were actually more than enough to cover the current account deficit, negative 38 million.
Exactly. In that case, after maybe accounting for some small statistical discrepancies, errors and omissions, the overall balance was essentially zero. And crucially, because the autonomous capital inflows fully covered the current account deficit.
The RBI didn't need to intervene, didn't need to touch its reserves.
Correct. In that scenario, the capital account itself, through autonomous flows, did the job of balancing the BIBO. There were effectively zero accommodating transactions needed from the RBI. The reserves remained stable.
Okay, so we've seen why money moves across borders, trade, investment, and how we keep score, BOP. Now, let's get to the price of that money. How is the exchange rate actually determined? Where does this happen?
Right, that happens in the foreign exchange market, often called Forex or FX.
Forex market. Is that like a specific building, like the stock exchange?
Not really, no. It's not a single physical place. It's a vast, decentralized global network. Think of it as a worldwide web connecting banks, brokers, multinational corporations, investment funds, and, yes, central banks. They're all trading currencies with each other electronically.
And it's running all the time.
Pretty much. It operates 24 hours a day, about 5.5 days a week, following the sun around the globe from Tokyo to London to New York. It's incredibly active and liquid.
Wow. And the key thing that comes out of this massive market is the foreign exchange rate itself.
That's the main output, yes. The price of one currency in terms of another. Like we said, maybe $1 equals Rs.75 today. That rate is the crucial link connecting costs and prices for goods, services, and assets across countries.
And if that rate changes, say, from $1 equals Rs.75 to $1 Rs.80.
Then suddenly, every single imported good becomes more expensive for us here in India. And Indian goods become cheaper for Americans. It has immediate, widespread effects.
Okay, so what drives the rate? Let's think about basic supply and demand. What creates the demand for foreign exchange? Why do people in India need dollars or euros or yen?
Good way to approach it. The demand comes from any transaction that requires us to pay foreigners, meaning an outflow of rupees to get foreign currency. So, number one, purchasing foreign goods and services import.
Right, buying that graphics card.
Exactly. Number two, sending gifts or transfers abroad. Maybe the government sending foreign aid or individuals sending money to relatives overseas.
Okay.
And third, increasingly important, purchasing foreign financial assets. If an Indian firm wants to invest abroad or you want to buy U.S. stocks, you need dollars first. That's demand for foreign exchange.
Imports, transfers out, buying foreign assets.
Got it. Now, how does this demand react to the price, the exchange rate itself? Let's say the price of a dollar goes up in terms of rupees. It moves from Rs.75 to Rs.80.
Okay, so dollars are now more expensive. That means foreign goods instantly cost more rupees. That graphics card looks pricier.
So basic economics law demand suggests we'd probably buy fewer imported goods if they get more expensive.
Generally, yes, assuming other things stay the same. If imports become more expensive, the quantity demanded of imports tends to fall. And if we're demanding fewer imports, we need less foreign currency to pay for them.
Meaning the quantity demanded of foreign exchange, dollars in this case, will fall as its price, the exchange rate in rupees, rises. Exactly. So the demand curve for foreign exchange slopes downward. Higher price, lower quantity demanded.
Makes sense. Now the other side, the supply of foreign exchange. Where does the supply of dollars or euros coming into India originate? Why are foreigners offering their currency in exchange for rupees?
It's essentially the mirror image of demand. Foreign currency flows into India primarily for three reasons. First, and very importantly, are exports. When foreigners buy Indian-made goods or services, they need rupees to pay for them, so they supply their dollars or euros.
Okay, exports are a source of supply.
Second, gifts or transfers coming into India,
You're okay.
remittances from Indians abroad, or foreign aid received by India.
Right.
And third, foreigners buying domestic Indian assets, that FDI flowing into Bangalore or FIIs buying shares on the Bombay Stock Exchange. They supply foreign currency to get the rupees needed for those investments, capital inflows.
Exports, transfers in, foreigners buying Indian assets. Now, how does supply react to the price? Let's use the same example. The dollar's price rises from Rs.75 to Rs.80.
Okay, so $1 now buys more rupees, 80 instead of 75. Think about it from the foreigner's perspective. An Indian product, say a hand-woven rug, priced at Rs. 7,500.
Before the change, that cost the American buyer $100, 7,500, 7,500.
Right. But now, at the new rate of Rs. 80 per dollar, that same Rs. 7,500 rug only costs them $93.75, 7,580.
Ah, so Indian goods have become cheaper for foreigners when the rupee depreciates. Dollar appreciates.
Exactly. This makes our exports more competitive internationally. If our goods are cheaper, foreigners will likely buy more of them.
And if they buy more exports, they need to supply more foreign currency to pay for them.
Correct. So a rise in the price of the dollar, the exchange rate, tends to increase the quantity supplied of dollars. The supply curve for foreign exchange slopes upward, higher price, higher quantity supplied.
Okay, so we have this downward sloping demand curve for foreign exchange and an upward sloping supply curve. They meet somewhere, presumably, at an equilibrium price and an equilibrium exchange rate.
In theory, yes, where demand equals supply.
But how is that rate actually managed or determined in the real world? Do governments just let the market decide, or do they intervene?
Ah, that's the big question of exchange rate regimes. Broadly speaking, countries adopt one of three main approaches: flexible, fixed, or a hybrid called managed floating.
Let's start with the pure market one. Flexible exchange rate, also called floating, right?
Exactly.
Yeah.
In a pure flexible system, the exchange rate is determined solely by the interplay of market demand and supply forces. There is absolutely no intervention by the central bank. The rate just floats wherever the market takes it.
So if demand for dollars suddenly surges, maybe because, say, Indian interest rates fall and U.S. rates rise, making U.S. bonds super attractive.
Right. That means Indian investors want to shift funds to the U.S. They rush to buy dollars, selling rupees. The demand curve for dollars shifts sharply to the right.
And with no intervention, the price just goes up. The exchange rate rises.
Precisely. The equilibrium point moves up along the supply curve. Maybe the rate goes from $1 is 75 to $1 is ours 80, or even higher.
And when the domestic currency becomes cheaper like that, we pay more rupees for $1. What's that called?
That's called depreciation of the domestic currency, the rupee in this case. Its value, in terms of foreign currency, has fallen purely due to market forces.
Okay, depreciation. And the opposite. If maybe there's a huge surge in foreign investment into India, increasing the supply of dollars.
Then the supply curve for dollars shifts right. The equilibrium rate would fall, maybe to $1 is ours 70. We pay fewer rupees for a dollar.
And that's quite...
Appreciation of the domestic currency, the rupee. Its value has risen due to market forces. So in a flexible system, it's all about depreciation and appreciation driven by demand and supply shifts.
But what causes those shifts? It's not just about buying goods, right? You mentioned capital flows.
Oh, absolutely. In the short to medium run, capital flows and expectations often dominate exchange rate movements. One huge factor is speculation.
People trying to guess where the rate is going.
Exactly. Money itself is an asset, and its future price, the future exchange rate, is something traders constantly try to predict. Let's say big institutional investors believe the British pound is going to appreciate against the rupee soon. Maybe they expect it to go from Rs 100 to Rs 105 per pound.
So they'd want to buy pounds now before the price goes up.
You bet. They'll aggressively sell rupees and buy pounds in the forex market today. This sudden surge in demand for pounds immediately pushes the current exchange rate up towards Rs 105.
Wow, so their belief actually makes it happen. It's self-fulfilling.
It can be, yes. This is why speculative attacks can be so dangerous. If the market collectively decides a currency is going to fall, their actions can make it fall, sometimes dramatically. Central banks watch speculative behavior very, very carefully.
Okay, speculation is one driver. What else? You mentioned interest rates.
The interest rate differential. This is massive. Think about trillions of dollars of mobile capital, sometimes called hot money, constantly scanning the globe for the best, safest return.
So if the U.S. raises its interest rates, making U.S. government bonds pay, say, 5%, while Indian bonds are still paying 4%.
That 1% difference might seem small, but for huge amounts of money, it's very attractive. Global investors will sell rupees, driving down its value, and buy dollars, driving up its value, to move their funds into those higher-yielding U.S. bonds.
So a country raising its interest rates tends to strengthen its currency.
Generally, yes, by attracting capital inflows. This highlights a key tension. In an open economy, a country's monetary policy, setting interest rates, isn't totally independent. Changing interest rates immediately impacts the exchange rate through these capital flows.
Interesting trade-off. Okay, circulation, interest rates. Anything else major?
One more factor often cited is relative income growth. Suppose India's national income starts growing much faster than, say, Europe's.
Good news, right?
Mostly, yes. But think about imports. As our incomes rise, we tend to buy more of everything, including imported goods. Remember that marginal propensity to import.
Right. Higher income means higher imports.
So if our income grows faster than the rest of the world's, our demand for imports, and thus our demand for foreign currency, might grow faster than the world's demand for our exports, the supply of foreign currency.
Meaning the demand curve for foreign exchange shifts out faster than the supply curve.
Often, yes. And the typical result of that is a tendency for the domestic currency, the rupee, to depreciate over time relative to the currencies of slower-growing economies.
Fascinating. So many dynamic factors. Now, what about the long run? Is there any theory that predicts where exchange rates might settle eventually?
For the long run, economists often turn to a theory called purchasing power parity, or PPP. It's an elegant idea, though it doesn't always hold perfectly in reality.
Purchasing power parity. What's the basic idea?
The core idea is that in the absence of trade barriers and transport costs, the exchange rate between two currencies should adjust so that an identical basket of goods and services costs the same amount in both countries. It's basically the law of one price applied to entire economies.
Okay, so if a specific shirt costs, say, $8 in the US and exactly Rs 400 in India,
Then the PPP theory suggests the exchange rate should be $1 equals Rs 50.
or 408,
And if the actual market rate was, say, $1 equals Rs 60,
then the shirt is cheaper in the US, $8 than in India, where $8 would buy Rs 480 more than the Rs 400 price. Traders could theoretically buy shirts in the US, ship them to India, sell them for Rs 400, convert back to dollars at Rs $61, and made a profit. This arbitrage should increase demand for dollars to buy US shirts and increase supply of rupees, pushing the rate back towards Rs 50.
ship being the operative word, does it actually work like that?
Well, that's the tricky part. PPP is a long-run tendency. In the short and medium term, it often doesn't hold very well. Why? Two big reasons.
Okay.
First, transaction costs. Real-world trade isn't free. There are shipping costs, insurance, tariffs, import quotas, all sorts of barriers that prevent that perfect arbitrage from happening instantly or completely.
Right, friction in the system. And second, maybe even more importantly, non-tradable goods and services. Think about things like haircuts, restaurant meals, university tuition, local transportation. You can't easily trade these across borders.
True, you can't import a haircut from New York.
Exactly. And since the prices of these non-tradables can vary hugely between countries, the overall price levels, including both tradables and non-tradables, won't necessarily equalize perfectly through the exchange rate.
So PPP is more of a rough guide than a precise predictor.
For the level of the exchange rate, yes, but it's actually much better at predicting changes in exchange rates over the long run, especially due to differences in inflation.
Ah, okay. How does that work?
Let's go back to the shirt example. $8 in the US, Rs 400 in India, implying a PPP rate of Rs $510. Now, suppose India experiences 20% inflation, so the shirt price rises to Rs 480, but US prices stay stable at $8.
Okay.
For purchasing power to remain equal, the exchange rate must adjust. The rupee needs to become cheaper relative to the dollar. The new PPT rate would be Rs 400 and $15.
So the rupee needs to depreciate from 50 to 60 to offset the higher inflation in India.
Precisely. PPP suggests that, over time, currencies of countries with higher inflation rates will tend to depreciate against currencies of countries with lower inflation rates, just to keep relative purchasing power roughly in line. It's a powerful long-run tendency.
Okay, so that's the flexible system, driven by markets, speculation, interest rates, PPP in the long run. What about the opposite extreme, the fixed exchange rate system?
Right. In a fixed system, the government or the central bank officially declares a specific exchange rate, a peg, and commits to maintaining it. They basically say the rate is $1 equals Rs 75, period.
Right.
Regardless of where market demand and supply might want to push it on any given day.
How can they possibly maintain that if the market disagrees? Say if massive capital inflows are pushing the market rate down towards Rs 70, but the government wants to keep it fixed at Rs 75.
They have to intervene constantly. In your example, at the official fixed rate of Rs 75, the rupee is artificially weak, cheaper than the market equilibrium of Rs 70. This means there will be an excess supply of dollars in the market, more people wanting to sell dollars for rupees at Rs 75 than people wanting to buy dollars.
Okay, too many dollars floating around.
To prevent the rate from falling to the market level of Rs 70, the RBI must step into the market and buy up all those excess dollars using rupees.
So they're absorbing the excess supply and
Yeah.
adding those dollars to their official reserves.
Exactly. They maintain the peg by becoming the buyer of last resort for foreign currency. But this requires them to have potentially huge amounts of domestic currency, rupees, available to buy up the dollars, and it leads to a buildup of foreign reserves.
What about the other way around? What if the government fixes the rate too strong? Say they fix it at $1 as Rs 70, but the market equilibrium is actually Rs 75 due to high demand for imports.
Now you have the opposite problem. At the fixed rate of Rs 70, the rupee is artificially strong. Dollars are cheap. This creates excess demand for dollars. Everyone wants to buy cheap dollars to pay for imports or foreign assets.
So a shortage of dollars at the official price.
Right. To maintain the peg at Rs 70 and satisfy that excess demand, the RBI must now sell dollars from its official reserves into the market.
Ah, so they have to actively supply the dollars the market is demanding? This means their reserves are going down.
Precisely. They maintain the peg by becoming the seller of last resort. But this only works as long as they have sufficient reserves to sell. If the reserves run low,
Then the credibility of the peg collapses.
instantly. If the market suspects the RBI is running out of dollars to defend the Rs 70 rate, They know a devaluation is coming.
Okay, you use the word devaluation. Is that different from depreciation?
Yes, the terminology is specific here. In a fixed exchange rate system, if the government officially increases the exchange rate, where she changes the peg from $1 equals Rs70 to $1 equals Rs80, making the rupee officially cheaper. That deliberate policy action is called devaluation.
Okay, devaluation, official weakening in a fixed system.
And if they officially decrease the exchange rate, indamfully move the peg from $1 Rs80 to $1 equals Rs75, making the rupee officially stronger, that's called revaluation.
Revaluation, official strengthening in a fixed system. Got it. Depreciation and appreciation are for flexible rates driven by markets. Devaluation and revaluation are for fixed rates changed by policy.
You've nailed it. And this brings us to the biggest danger of fixed rate systems, the speculative attack.
You mentioned speculation before, but how does it specifically target a fixed rate?
It happens when speculators believe the fixed rate is unsustainable. Maybe they see the country running huge, persistent current account deficits, meaning the RBI is constantly selling reserves to defend the peg. They see reserves dwindling.
So they anticipate that the government will eventually be forced to devalue.
Exactly, and they want to profit from it. So what do? They borrow massive amounts of the local currency, rupees, and immediately sell them in the forex market, demanding foreign currency dollars at the current fixed rate.
Creating even more artificial demand for dollars.
Enormous demand. They're basically betting against the central bank. This sudden, massive selling pressure on the rupee puts immense strain on the RBI's remaining reserves. If the attack is big enough, it can wipe out the reserves very quickly.
Forcing the government's hand, they have to give up the peg and devalue.
Often, yes. And typically, the resulting devaluation is much larger and more chaotic than if they had adjusted the rate earlier. The speculators make huge profits, and the country suffers a currency crisis. This happened famously during the Asian financial crisis in 1997-98. It's the Achilles heel of fixed regimes.
Sounds risky. So what are the benefits of flexible rates then? They avoid this attack risk.
They largely do, yes. Flexible rates mean the government doesn't need to defend a specific rate, so they don't need massive reserves, and they're not vulnerable to these kinds of attacks in the same way. Plus, it gives them more independence in setting domestic monetary policy. They can set interest rates based on domestic needs without worrying quite as much about immediate exchange rate consequences. And the exchange rate acts as an automatic stabilizer for the BIOP. A deficit tends to cause depreciation, which makes exports cheaper and imports dearer, helping to correct the deficit over time.
But the downside is volatility. Makes planning harder for businesses.
That's the main drawback, yes. Constant fluctuations in the exchange rate can create uncertainty for importers, exporters, and international investors.
So fixed is vulnerable to attacks but stable day-to-day if credible, while flexible is resilient but volatile. Is there a middle ground?
There is, and it's what most countries, including India, practice today. It's called managed floating, sometimes less politely called dirty floating.
Managed or dirty floating. Okay, what does that involve?
It's basically a hybrid. The exchange rate is generally allowed to float, determined by market forces. That's the floating part. However, the central bank monitors the market closely and reserves the right to intervene, buy or sell foreign currency, if it feels the movements are becoming too erratic, too volatile, or moving too far away from what they consider a desirable range. That's the managed part.
So they don't defend a specific number, like in a fixed system, but they try to smooth out the bumps.
Exactly. They intervene not to rigidly peg the rate, but just to moderate its movements to prevent excessive volatility that could harm the economy. Under this system, official reserve transactions are usually not zero because the central bank is intervening occasionally, but they aren't draining or accumulating reserves continuously like in a pure fixed system. It's seen as a practical compromise.
Okay, this is great. We've covered how money flows, how it's tracked, how its price is set. Now let's bring it all back home. How does being an open economy affect our overall national income, our GDP? Specifically, how does it change that multiplier effect we learned about in the closed economy model?
Ah, yes, the open economy multiplier. This is where we see one of the most significant policy implications of global integration. It really changes how effective things like government spending are.
Let's start by reviewing the basic national income identity. In a simple closed economy, aggregate demand, which equals income Y in equilibrium, was just consumption C plus investment I plus government spending G. So $1 equals C plus I plus G.
Correct. Now, in an open economy, we have to account for international trade. We add exports, X, because that's foreign demand for our goods adding to our income. But we must subtract imports, M, because that's our demand falling on foreign goods leaking out of our income flow.
So the demand for domestically produced goods is Y dollars equals C plus I plus G plus X, Emma.
Exactly. Or more commonly written as $C plus I plus G plus NX dollar, where NX dollar stands for net exports, which is simply sexanol.
Say $C plus I plus G plus NX doll. Now, to understand the multiplier, we need to think about how imports behave. What determines how much we import?
Well, imports depend on a couple of key things. Firstly, they definitely depend positively on our own domestic income. As India gets richer, as our national income goes up, we tend to buy more of everything, including imported goods.
Makes sense. Higher income, more spending, some of it on imports.
Right. Imports might also depend on the exchange rate. If imports become cheaper due to currency appreciation, we might buy more. But for the basic multiplier model, let's assume the exchange rate and foreign income are fixed for now. We can then write a simple import function.
Like the consumption?
Exactly, analogous. We say imports have some baseline autonomous level, let's call it TLAM stuff we'd import regardless of income, like maybe essential oil or defense equipment. And then there's an induced component that depends on income. Lemery times Yordo.
So the import function is 1 bar plus my A.
Perfect. And that little m there is incredibly important. It's the marginal propensity to import.
Marginal propensity to import.
So, similar to the marginal propensity to consume, C, precisely. Ohm represents the fraction of each extra rupee of income that people spend on imports. If one marries $1 1 cent, it means for every additional 100 rupees of income earned in India, 10 rupees immediately leak out to buy imported goods.
Okay, dollars are the leakage rate for imports out of extra income. How does this change the multiplier?
It changes everything. Remember, in the closed economy, the only leakage from the income stream, apart from saving, was implicitly assumed to be just saving itself, related to one with EC. Now we have another leakage imports related to not about.
So when we derive the formula for the equilibrium income in the open economy, taking this import function into account.
The autonomous expenditure multiplier turns out to be frac 1C plus M.
Let me look at that. The closed economy multiplier was frac 1C plus M.
Yeah.
Now it's frac 1C plus M. Since M, the marginal propensity to import, must be positive. We import something when income rises.
Right, on dollars.
That means we're adding a positive number in the denominator. That makes the whole denominator $1C plus M larger than the old denominator $1.
Exactly. And if the denominator is larger,
the value of the fraction, the multiplier itself, must be smaller.
Bingo. The open economy multiplier is definitively smaller than the closed economy multiplier.
Wow. So opening up to trade actually reduces the impact of things like government spending.
Yes. Think about why. Imports act as an additional leakage from the circular flow of domestic income. When the government increases spending, the dollars, that boosts income. People then increase their consumption based on C. But now, a part of that induced consumption, specifically the M part, isn't spent on domestically produced goods. It flows straight out of the country to pay for imports.
So the stimulus gets diluted because some of it leaks abroad immediately.
Perfectly put. The impact on domestic production and income is dampened. Let's use that numerical example from the source, example 6.2, to really hammer this home. It makes it crystal clear.
Okay, what were the numbers?
Suppose the marginal propensity to consume is 0.8 cents. So people spend 80 pays of every extra rupee, and let's say the marginal propensity to import is 0.3 cents. So people spend 30 pays of every extra rupee on imports.
Okay, C 0.8 and 0.3. What's the closed economy multiplier?
In a hypothetical closed economy where M0, the multiplier would be FAR 1 1.8, FAR 1.2, 5 of 5.
A multiplier of 5. So a RS 100 crore increase in government spending would raise national income by RS 500 crore.
Right. Now, let's calculate the open economy multiplier using $1.33 plus M FAR 1 1.8 plus 3.2 plus 0.3 plus 0.5.
Well, the multiplier drops from 5 down to just 2.
Exactly. So now that same RS and a crore increase in government spending only raises national output by RS 200 crore in this open economy.
That is a massive difference. More than half the impact just vanished because of import leakage.
It really highlights how domestic fiscal policy using government spending or taxes to manage aggregate demand becomes significantly less potent the more open an economy is, and the higher its propensity to import, the higher M is. A big chunk of any stimulus just leaks out across the border.
This also means we're more affected by external shocks, right? What happens if exports change?
Good point. An increase in exports, delta XOAM, Maybe because the global economy booms and foreigners start buying more Indian goods, acts just like an increase in government spending. It's an autonomous injection of demand. Its impact on our equilibrium income would be delta X or day times the open economy multiplier. So external demand shocks get multiplied too.
And what about an autonomous change in imports? Say everyone suddenly really wants the new iPhone, increasing delta.
An autonomous increase in import demand, delta bar acts like a negative shock. It's an increase in autonomous leakage. It would cause the equilibrium national income to fall by delta bar times the multiplier. So yes, the open economy is much more sensitive to these global demand shifts than the closed model would suggest. Hashtag tag outro.
Okay, wow. We have really covered a lot of ground here. We've gone from just defining what an open economy is through the detailed accounting of the balance of payments.
Yeah, figuring out the current and capital accounts and that crucial balancing role played by the RBI's official reserves.
Then into the Forex market. How demand and supply, speculation, interest rates shape the exchange rate under different systems, like flexible, fixed, and managed floating.
And finally, bringing it all back to show how opening up to the world, specifically through that import leakage, fundamentally changes the impact of domestic policy through the smaller open economy multiplier.
It feels like the core lesson, really, is that interconnectedness matters immensely. Your individual choice to buy an imported product has ripples. And globally, things like interest rate changes or shifts in trade flows can really alter a nation's economic path because of these mechanisms.
Absolutely. That import leakage effect on the multiplier is such a key takeaway for understanding policy limitations in the modern globalized world.
Now, for a final thought, a challenge for you listeners to ponder. We talk about how a current account deficit has to be financed by a capital account surplus, basically, by borrowing from abroad or selling assets to foreigners.
Right. The deficit needs financing through capital inflows.
Should a country always be worried if it's running a persistent current account deficit? Is it automatically a bad sign?
That's a fantastic question to chew on. Think about the type or the quality of the capital inflow that's financing that deficit.
What do you mean by quality?
Well, is the deficit being financed by stable, long-term foreign direct investment, FDI? Foreigners building factories, bringing in technology, creating jobs. Or is it being financed primarily by short-term volatile portfolio flows, FII, or by accumulating foreign debt that needs constant refinancing?
Ah, I see. So financing a deficit with FDI might feel more sustainable and beneficial than financing it with hot money that could leave at any moment.
Exactly. Which type of financing gives the government and the central bank more stability, more comfort, and what might happen to your currency and your economy if that deficit is being funded by volatile capital that suddenly decides to reverse course?
That really adds another layer to analyzing the BA data. It's not just about the balance, but the nature of the flows. Lots to think about there.
Definitely your next level of exploration. Thank you so much for joining us on this deep dive into Econ 2. We are Adam and Grace, proud educators from School on X. We hope this breakdown of open economy macroeconomics was helpful, and we look forward to exploring the next concept with you.
See you next time.